Bank of America has signaled a notable shift in its approach to precious metals, announcing a strategic adjustment that has captured the attention of both investors and market analysts. The financial institution, one of the largest in the United States, is reported to have effectively waved the white flag regarding its previous position on silver trading, specifically relating to the $309 silver alert. This development reflects a broader reassessment of market conditions, risk management strategies, and institutional priorities in the context of fluctuating commodity prices and economic uncertainty. The announcement comes amid a period of increased volatility in the precious metals sector. Silver, often considered both an industrial metal and a hedge against inflation, has experienced sharp swings in value over the past several months. While market participants have been closely monitoring these movements, Bank of America's latest decision has introduced a new layer of analysis for traders and investors. Sources indicate that the bank's approach to the $309 silver alert reflects a combination of technical considerations, client risk exposure, and broader macroeconomic trends that have influenced institutional investment behavior. Analysts note that the $309 silver alert functions as a significant benchmark within the trading community. It is not merely a numerical marker, but serves as a signal for potential shifts in market momentum. Historically, institutions have used such alerts to guide trading strategies, adjust positions, and communicate risk thresholds internally. Bank of America's recent actions suggest a recalibration of these thresholds, potentially indicating a reduced appetite for aggressive silver positions under the current market conditions. This recalibration is viewed by some observers as a practical response to ongoing uncertainty rather than an abrupt policy reversal. In explaining the rationale behind its decision, industry insiders suggest that Bank of America has considered several intersecting factors. Chief among these is the current macroeconomic environment, characterized by fluctuating interest rates, currency valuation shifts, and global demand dynamics for industrial metals. Silver, in particular, is sensitive to changes in industrial output, investor sentiment, and geopolitical developments that can influence supply chains. By adjusting its exposure and signaling a retreat from its previous stance, the bank may be aiming to maintain stability for its clients while mitigating potential losses in a volatile trading environment. Market commentators have emphasized that such institutional movements often have ripple effects across the broader investment landscape. When a major bank like Bank of America revises its strategy on a high-profile commodity alert, other market participants frequently reassess their own positions. This can lead to adjustments in trading volume, price expectations, and investor behavior. While the immediate market response to the $309 silver alert remains under observation, preliminary indications suggest that the announcement has prompted a measured reassessment among both retail and professional traders. It is also important to recognize the broader context in which this decision occurs. The precious metals market has been influenced by multiple converging trends, including central bank policies, inflationary pressures, and international trade considerations. Silver, as a commodity with both financial and industrial utility, is particularly affected by these forces. By signaling a strategic pause or adjustment, Bank of America is engaging in what many analysts view as a cautious, risk-conscious approach designed to protect its portfolios and clients from unexpected market swings. Bank officials have reportedly emphasized that the decision does not indicate a permanent exit from silver trading. Instead, it represents a temporary recalibration in response to specific market conditions. This distinction is critical for investors, as it suggests that the bank remains engaged in the sector but is exercising prudence in managing exposure. By carefully navigating the $309 silver alert and related thresholds, Bank of America is seeking to balance opportunity with risk management, a strategy consistent with standard practices in institutional investment. As this situation develops, financial observers will continue to monitor subsequent moves from Bank of America and other major players in the commodity markets. Analysts will be watching for signs of renewed activity, potential adjustments in pricing models, and any broader implications for precious metals trading. In addition, regulatory and reporting frameworks will provide further insight into how large institutions adapt to market signals like the $309 silver alert, offering a window into the decision-making processes behind high-stakes investment strategies. With the backdrop of ongoing market volatility and evolving economic indicators, the implications of Bank of America's decision extend beyond the immediate silver market. The move highlights the importance of strategic flexibility, institutional risk management, and careful analysis in navigating commodity markets that are increasingly influenced by global economic trends. It also underscores the interconnected nature of modern finance, where actions by major banks can shape perceptions, strategies, and outcomes across multiple sectors. As investors, traders, and analysts digest the full scope of this announcement, attention will now turn to the unfolding effects in the coming days and weeks. The $309 silver alert serves as a focal point for ongoing discussions, while Bank of America's recalibrated stance provides a case study in institutional response to shifting market realities. In the next segment, we will examine the broader consequences of this development, explore the detailed market reactions, and assess what this may mean for future trading strategies and investment decisions. Turning now to the broader implications of Bank of America's recalibration of its silver strategy, market analysts note that the decision may signal a subtle shift in institutional sentiment toward precious metals more generally. While silver has traditionally served as both an industrial commodity and a hedge against inflation, its recent volatility has prompted careful evaluation by major financial institutions. By stepping back from aggressive positioning around the $309 silver alert, Bank of America appears to be emphasizing risk management over speculative opportunity, a move that could influence behavior across multiple sectors of the financial markets. Traders and investors are already beginning to assess the potential ripple effects. In the immediate term, the recalibration may lead to decreased trading volumes at specific price points as market participants adjust expectations and reevaluate exposure. Analysts suggest that other large banks and institutional investors may take a similarly cautious approach, particularly if silver prices approach or exceed the $309 benchmark. This could temporarily dampen market activity, but may also create a more stable trading environment in which risk is more evenly distributed and less prone to sudden, large-scale swings. Industry commentators have also highlighted the broader economic factors underpinning Bank of America's decision. Silver, unlike gold, has significant industrial applications, particularly in electronics, solar energy, and medical devices. As a result, demand for the metal is closely tied to manufacturing activity and global economic growth. Recent fluctuations in industrial output, combined with supply chain constraints and geopolitical considerations, have increased uncertainty around pricing. Bank of America's strategy, according to financial experts, reflects an understanding of these interconnected dynamics and a deliberate approach to mitigating exposure during periods of potential volatility. In addition to market and economic considerations, regulatory frameworks play a role in institutional trading decisions. Banks are required to manage risk in accordance with capital adequacy standards, reporting obligations, and internal compliance policies. Adjustments to trading strategies, including responses to alerts like the $309 silver marker, often incorporate these requirements. By signaling a temporary retreat, Bank of America may be aligning its operational practices with both regulatory expectations and internal risk management protocols, ensuring that client portfolios and institutional holdings remain protected under a range of market conditions. The response among retail investors and smaller traders has been mixed, reflecting the influence of major institutional signals on market psychology. Some investors interpret the bank's move as a cautionary measure, prompting adjustments to personal portfolios or hedging strategies. Others view it as a neutral recalibration, emphasizing that the bank's decision is specific to the current market environment and does not constitute a long-term exit from silver trading. Financial commentators note that such institutional movements often serve as reference points for market sentiment, shaping expectations and influencing trading decisions at multiple levels of the market hierarchy. Looking ahead, experts anticipate that silver prices and trading patterns will continue to be shaped by a combination of supply, demand, and macroeconomic factors. Central bank policies, interest rate adjustments, and broader commodity trends are likely to play significant roles in determining price trajectories. Bank of America's recalibration may serve as a model for other institutions navigating similar conditions, highlighting the importance of flexible strategy and careful monitoring in managing exposure to highly volatile assets. In this context, the $309 silver alert functions as both a practical reference point and a symbol of the need for disciplined, data-driven decision-making in commodity markets. Ultimately, Bank of America's decision underscores a broader theme in contemporary finance: the need for institutional prudence in the face of uncertainty. While silver remains a critical component of diversified investment strategies, the recalibrated approach demonstrates the importance of balancing opportunity with caution. Analysts suggest that this move will likely contribute to a more measured and sustainable market environment, reducing the risk of sudden, destabilizing fluctuations while maintaining the potential for strategic gains as conditions evolve. As the situation continues to develop, market observers will be closely monitoring subsequent actions by Bank of America and other major financial institutions. The impact of this decision on the $309 silver alert, trading volumes, and investor sentiment will provide valuable insight into how large-scale players navigate shifting market conditions. For investors, traders, and policymakers alike, the recalibration offers a practical example of strategic adaptation, highlighting the interplay between institutional decision-making, market signals, and economic realities. In conclusion, Bank of America's measured response to the $309 silver alert reflects a thoughtful, risk-conscious approach to market participation. By balancing exposure, client priorities, and broader economic trends, the institution demonstrates how prudence and strategy intersect in the management of precious metals investments. While the immediate effects on silver prices are still unfolding, the announcement reinforces the importance of disciplined analysis and adaptive strategy in navigating complex financial markets.